All right, can you hear me now? Okay, just let me know if the sound goes off. I seem to have some headset problems. That's where I get my sound from, but we will jump on in for everybody else. Thank you all for attending today. It's important. This means you really care about your 401k, your retirement, and I'm so glad you're able to join us here. So we're going to touch on some things that have been going on with the markets. Again, my name is Dan Romero. I am the financial planner that's affiliated with your 401k plan. I am available for you to ask questions at any time. So feel free to email me, call me. We offer a no-cost retirement analysis if you want to see if you're on track for your own retirement. So take advantage of that service. But ultimately, at the end of the day, when we talk about plan participants, an educated client is our best client. So if you are educated about what's going on in the world right now, retirement planning, it really gives you a leg up. And so we want to help get you across the finish line. Now let's talk about what's been going on this year. We saw a bit of a rebound. Last year was certainly very painful for a lot of people. Not only did the stock market collapse, but the bond market had a lot of pain as well. But this year we're seeing some good things. The S&P 500 is up about 7% here, and the Dow Jones is up about 0.4%. So we're seeing a nice rally coming off of last year. Now, the thing about last year was that it was volatile in a couple different ways. This statistic we found particularly interesting. As we look through it here, you can see these are days in the market where the S&P 500 was either up 1% or more or down 1% or more. That's a good sign of volatility. Like the last couple of weeks in the market, it's been pretty mellow, not too much action either way. But when you get these big swings where it goes up more than one or down more than one, it adds to the stress level. And you can see that, you know, it may seem hard to believe, but there were actually 75 days where the market was up more than 1% last year. However, there were 76 days where the market was down more than one. And a lot of that just leads to panic and some indecision that can cause issues here. And it just shows you that's particularly high. We don't normally see that in a given year. Even during the COVID year, there were less down days to that extreme than what we had last year. So it was pretty rough. Now, inflation has been one of the big drivers that is causing us a lot of headaches. You can see in January, it was at 6.4. It's been moving its way down. February, 6.0. And the most recent numbers in May showed us at 4.9%. So we are headed in a good direction. Some of the things that the Fed have been doing seem to be working to attack inflation, but we've really seen the biggest driver with energy falling in a big way, as well as housing, but particularly energy has fallen. That's helping lead to these numbers. So what the Fed did is they aggressively raised interest rates last year. We had basically been at around a zero Fed rate for basically going back to COVID in 2020. And then we started to raise rates in March of 2022, a quarter of a point, and then went up pretty aggressively from that point on. So we essentially went from 0 to 5%. There's been a couple interest rate hikes since that point, so we're at about just about 5.5. There is talk that potentially there will be another one in June, but we may be at the end of the line. Now, this type of interest rate hike has effects on the bond market, and I'll get into that in a bit. But you can see here the Treasury yields remain very high. You can now actually make some money in bonds from the interest rate. That works well for our folks that are retired, and it's really certainly helpful. You know, Treasuries were at the center of what was going on with Silicon Valley Bank. What they would do is they would take their deposits and they would invest in long-term treasuries 20, 30 years down the line. Now you're seeing you're getting pretty handsome rates now, but when they bought a lot of these, the rates were maybe 1%. So when the run on the bank happened, they had to sell these things at big discounts. So that's been really been part of the problem on the banking side. But for short-term investors or people that are looking for safety, we're getting yields that we haven't seen in years. Now, when we look at this chart, it's very interesting. You can see where the Fed funds. So this red line indicates where interest rates were with the Fed fund rate. So coming out of the financial crash of 2008, they took it basically down to 0 for years. Then we had to creep up in 2016. And then when COVID hit, boom, dropped it all the way back down to zero again. And now we're even on this ladder almost straight up. The 3-month treasury bills follows it almost exactly. And you can see how that is. And it just means that we're getting paid pretty well on short-term debt. If you have money in savings, those type of things, check with your bank, see if you're getting close to zero and see if they have some sort of super saver rate. If not, you can give us a call. We can point you in the right direction. Now, this is the slide I was talking about a little bit earlier with regards to interest rates. So there's an inverse effect when interest rates go up. When rates go up, the value of bonds go down. So think of it this way. If you bought a $10,000 bond in the year 2021, maybe in January, you might have gotten 1% on that 10-year treasury, maybe. Well, rates went up. Now you can get almost 4% on a bond today. So let's say you bought that old bond. If you hold it to maturity, you'll get your money back. But let's say you needed to sell it. If you sold that bond today, who's going to want to buy it? When someone could turn around the street and buy one paying 4%, no one wants to buy your 1% bond. So in those instances, you would have to discount it and sell it for maybe 20% less to make it of interest to someone to buy. So that's what we saw last year. For people that were in intermediate to long-term bonds, the value on paper fell quite drastically. So when rates go up, the value of bonds go down. Where's my cursor here? Now, inversely, we've seen rates go through the moon. And now we're getting paid handsomely again. The Fed has said maybe they'll raise rates one more time in June, and everything we see says potentially they might stop from that point on. In fact, they might start lowering rates. So this is something to consider. Maybe it's time to get back into longer duration bonds. If you're not sure about that, give us a call and we can coach you through, the difference in that type of thing. But interest rates have been dropping. If they drop, I should amend, expect the value of bonds to go up. So think of it the other way. If you bought a bond that's paying 4%, and rates go all the way back to where the bonds are now 2%, people are going to want your 4% bond. That's going to have more value because who doesn't want to get paid 4/2? So those are things to really think about when you're dealing with fixed income. Now, this is interesting. Even though rates have gone up, you can see the Fed funds rates at 4.85. A lot of banks are still paying very, very little. So if you don't make moves yourself, you might be earning nothing. So again, check with your bank, see if you have a savings number, but if not, we can certainly help you out. Now, the economic news has definitely been mixed. Inflation has been going down from the energy sector and housing, but we have still seen pretty high prices out in the grocery store. So that's still above us. The geopolitical uncertainty remains around the world with everything that's going on with Ukraine and China, the dollar, things like that. But then on the flip side, the unemployment statistics have still been working out pretty favorable. We have low unemployment rates still. Jobs continue to be added. So we'll see. Everything kind of predicts that we're headed into a recessionary environment, but certain aspects of the economy are still doing well. So with that said, for the folks that do invest with us directly, we have been proceeding with caution. So again, we offer that service to our participants. You're welcome to give us a call and we can give you ideas and things that you might consider of your risk tolerance. We can't give specific investment recommendations with a 401k, but we can help educate you so that you kind of know what works for you. The thing about stock market investments, this is a good thing to understand. The portion you do have in the stock market, you want to consider that as a long-term investment. You will have ups and downs, but ultimately over the long term, the stock market tends to reward folks that show patience. We'll have some good quotes from Warren Buffett in a bit here that kind of touch on that. But some of the key takeaways from today is maybe we might get one more interest rate hike. I don't know if we'll get too many more from that, but they could be coming to a close on that front. Borrowing costs have become much more expensive. If you need to get a refinance on your house, you're looking to buy something, the rates are much higher than they were a year ago. Take a look at any income producing investments. If you have stuff outside of us and you're trying to get yield, there's a lot more yield available to you. I would always say be careful about the media. They're more inclined to want to talk about things that grab headlines and create panic because that gets ratings. So you got to be careful. So give us a call if you have questions about anything you hear out there. And again, practice patience. Focus on the long term. That's how you win with the markets. The bear market looks like it's continuing for now. We're moving a little bit out, but still good to be cautious. a good thing to do when we head into a recessionary environment is to revisit your budget and determine what's really necessary and what's just sort of a discretionary spend. Have a well-devised plan that's tailored to your situation. Again, that's something we can help you with, and we're recommending proceed with caution. And we are here for you. You can call us at any time. So I kind of touched on this, Buffett's letter to the shareholders. They just had their big meeting. He's considered one of the smartest investment managers in the world. But some good quotes that came out of his recent meeting. The weeds wither away in significance as the flowers bloom. So that means, when things are getting better, when the market is returning, you'll see some of the negative stuff go out of the way. Charlie Munger, his partner, mentioned the world is full of foolish gamblers, and they will do not as well as the patient investor. That speaks to folks that are looking to chase the hottest fad, those type of things. Those type of investments really got hit hard last year. So you need to be cautious when you're getting mixed up in something that maybe shows a really good return right now. It can fall off a cliff pretty quickly. And I like this one as well, because there is issues with the dollar around the world, and people are saying, what's going to happen with the U.S.? But he kind of mentioned, I've yet to see a time when it made sense to make a long-term bet against America. And I doubt very much that any reader of this letter will have a different experience in the future. So again, the United States still is the bellwether of the world. We do feel we're going to work our way through this thing. There has been a lot of nonsense that's been going around the world, but we think things are pretty good. They will be over the long term. So keep us in mind. If any of your fellow participants, if you got value out of this presentation or we had in the back, feel free to let your plan administrator know that hey, this was pretty good. I got some good information out of it. And feel free to let any employees that they're like, hey, it's worth sitting on. We also do what's called a market minute, where we, at the end of each week, we kind of talk about what we're doing on our wealth management side, some moves we've been making. That's on our YouTube channel, which is Romero LPL. So feel free, you can get to that from our website as well, which is danromero.com. And so if you want to get sort of a weekly update, we keep it to about a minute, so it's short and sweet. Nice little update we do for you. And that could be something you could share with your friends as well. This is all the compliance that you need to know about. This is the most important part of the meeting. And so, be sure to take a look at that. But with that said, we kind of are at the end of the line here. If anybody has any questions, let me know. I'm happy to answer. And if you have something offline, feel free to email me at dan.romero@lpl.com. You can also go to my website and just go to contact us, and you can get a hold of me that way as well. Ask your plan sponsor for my contact info at any time too. So that's all we got for today. So I want to thank you all for joining us, and hit me up with any additional questions. Short and sweet, just like we promised you. Have a good rest of the week.